What about staying invested all the time, but selling and buying every 4 or 5 years? Let's dive into active investing.
Fellow investors, bonjour! This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Veronique will help you invest with more conviction so you can enjoy your retirement.
Dividend growth investors, bonjour. Vero here, and you're listening to the Dividend Guy blog podcast. We have a guest on the show today, and it should be pretty interesting. Our investing approaches are so different that you will find me out of my comfort zone. While my strategy is about dividend growth stocks, Joseph has been exploring other things from ETFs to bonds and penny stocks. Without further delay, let me introduce you to Joseph Hogue, former Marines, CFA, and YouTuber. Hello, Joseph. Welcome to the podcast. How are you today?
I'm doing great. Thanks for having me.
It's a pleasure. I can't wait to discuss your strategy a little more. So, how would you describe yourself to those who don't know you?
Okay. Well, like you said, a former Marine. So I joined the Marine Corps after high school, went back to college after that, worked in real estate investment as well as equity analysis, and then finally on to venture capital analysis. And, eventually, obviously, into YouTube and blogging. And that I guess I'd call myself a reformed dividend investor, right? I think we all love seeing those dividend checks hit our account, and we all love the idea of that more immediate return on our investments. I realized that with a lot of those dividend stocks, you're not getting rich on those, right? They are obviously in more stable industries for the most part. They pay that dividend, which obviously means they can't reinvest all of those profits. So they're not going to be growing as much as maybe some of your tech stocks, right? And
Right.
so, at a point in my life where I realized, hey, well, one, I've still got decades until I might retire. And two, I may never retire because I love what I do so much. So then I started to think, okay, well, maybe I want to be a little bit more of a growth investor. Actually, I think we're maybe not so far apart in our investing styles. If you're a dividend growth investor, obviously
Right.
you still like to see stocks that are growing their earnings enough that they can grow that dividend. I like the stocks that are also growing those earnings, but then keeping those earnings back to reinvest in the company. Much more of a growth in price rather than a growth in dividends.
Right, right. And I mean, to me, dividend growth investing means that these companies are leaders in their industry, basically, but with growth stocks. So it's pretty much the same, but I believe that you might have to follow them a little closer, right?
I think the nature of dividend stocks, when I say dividend stocks, I mean both dividend growth, and maybe a little bit slower growth dividend stocks.
Mm-hmm.
But I think in
Sure.
dividend stocks, the nature of it that they are in more mature, stable industries and they have those consistent cash flows means, yeah, okay, maybe you don't have to follow them quite as much. They're a little bit more reliable. And in terms of those cash flows and that competitive advantage, a lot of these industries, they're going to be so much older. Maybe they're going to need capital expenditures are going to be so high to start something like that, that the threat of new entrants really is so low. You've got utilities, you've got consumer staples, where you've got that brand and that. So you don't really have to worry about new competitors coming in. And so, yes, those are much more stable. So
Mm-hmm.
you can kind of count on Pepsi to always do what Pepsi does, right? Whereas
Sure.
you're right, growth stocks, it is going to be a higher level of risk just because they're typically newer industries,
Mm-hmm.
faster growing industries that are going to attract those competitors to maybe get some of that growth and some of that revenue growth. So yeah, I think it would be fair to say that you probably do have to follow those stocks a little bit more closely as far as competitive advantages and cash flows and that kind of thing.
Right. Okay, so I'd like to go back to the marine part a bit. So Marines to me, like we don't have Marines in Canada, but it sounds like physical and mental discipline to me. So are these traits still part of your daily life today?
Well, sure. I think there's definitely a discipline part of it. I think that's probably the best definition of or what a Marine would say is a definition of a Marine is that discipline part. And I think it helps when you go out into, another career. It definitely helped me as in my analyst role. Sometimes you're working usually 50, 60 hours at a minimum as an equity analyst or venture capital analyst. Sometimes it can be up into the 80 hours a week and even higher during earnings season, things like that. So I
Hmm.
think the Marines and that discipline definitely helps you when you get to that point to say, hey, this is the job and you just have to do it. Today, I think the discipline is in really doing that whole process. On YouTube here, it's so easy to just half-ass the analysis, right? You see a lot of other channels that basically just look at a chart. Oh, that stock price is going up. Let's invest in that. And I think there's a temptation sometimes to just do that, right? To
Right.
just give people what they want, tell them to, hey, Nvidia will always go up. Just invest in Nvidia.
So
But I
true.
think I think you have to have that discipline to actually do the work, do the analysis, and really be able to follow stocks that way.
And how did it impact you as an investor? Like, do you think you are more focused and constant because of your background?
I think so. I think definitely it helps you go through the process, even though maybe there might be an easier solution or something that looks like a solution. Anyway, I think it resets your expectations, right? When you live in Spartan as a Marine on maybe $1,000 a month, then you don't seem to need a lot of the riches and the get rich quick schemes because you've lived with less and you've learn to live with
Hmm.
that. And so you can invest more even when your income grows and you're not quite chasing some of those get rich quick schemes, I think.
And what changed you the most, like being a Marine or becoming a father?
Sure, sure. Probably being a father, definitely. When you're a Marine, you've got mentors, you've got people telling you what to do and how to do. There are rules, right? With being a father, there's no guidebook for that. It's just kind of learn as you go a lot of times.
Yeah, I have three kids of my own, and I learn something every day, I'd say. Especially now that my oldest is like becoming a teenager, so
Okay,
sometimes things are getting harder.
sure.
So you started investing independently in 1999. What was your financial background then, and what triggered this move?
Sure. Well, at that point, I was still in the Marine Corps. I had no financial background, not even really college level finance course or investing courses. So I was really just the regular investor, right, getting started. And I think, over those last 25 years, I've made all the mistakes as an
Hmm.
investor. Obviously, in that time, then I went back to school, went through the Chartered Financial Analyst designation for that curriculum. I worked as an equity analyst. So I learned kind of the professional side of investing. But I think some of the biggest lessons have just been the mistakes I've made on my own. I think beyond that, I think a lot of people investing now can kind of relate to where I was back then, even more so just in the time, the era of investing we're at right now. Whether it goes on for another year or 2 years, I think it's undeniable we're in some kind of a stock market bubble, right? With AI stocks, the promise of how AI is going to change productivity. And we had
Hmm.
that same promise in 1999, right? With internet stocks and how that
Sure.
was going to change our lives. So I think it's definitely instructive because at that point we knew the internet was going to change our lives. We didn't know when, we didn't know by how much, and we did have that bubble crash. Eventually, a lot of those stocks went on to change our lives. So I think the same
Mhm.
can be said for now for some of those AI stocks that may get crashed out in a year or two, but to hold firm on the best ones of those, and they will eventually become the next Amazon. Really, I think.
Sure. And talking about AI stocks, like the big guys are already using AI. So, like in a way, investors who don't want to take too much risk could like invest in Microsoft and things like that. And they would use AI already and make profit on that instead of going for the AI stock in a basement somewhere.
Sure.
And also I wanted to ask you what gets you interested in pursuing an analyst career? Was it the
Sure.
fact to get in the market, or was it like an interest that you already had?
Sure. I think as a Marine, you make all of. I think I was at about $1,200 a month when I was first starting out in the Marine Corps. So there's always that paycheck to paycheck mentality where you do want something that is going to be a little bit better pay, a little bit more stable. When I got out of the Marine Corps, then I did start investing in real estate. Of course, this was right around 2001, 2002 when the U.S. housing bubble was just getting started. So everyone was getting
Mhm.
rich in that, and I wanted something of that as well. And I really did enjoy seeing my money work for me, having being able to invest and see those profits, right? Whether it's
Mhm.
through the cash flow from the rentals or just the price appreciation. So that got me interested in really investments in general. I started in real estate and saw kind of how much work that was sometimes managing my own rental properties. So then I looked to the equity side into the stocks and started kind of analyzing those. Did that for about 6 years as an equity analyst, and then transitioned into venture capital, which is kind of pre-equity, right? Pre-IPO investing into startups and
Hmm.
things like
Hmm.
that. So it was really kind of a progression from enjoying investing and the idea of investing into a little bit more specific into equity analysis, and then even more specific into venture capital analysis.
Okay, and do you remember what you first invested in?
I don't know that it was the very first stock I ever bought, but I did invest in Amazon back there in 1999. Of course, that crashed out, and I actually did sell it when it crashed. I wish I hadn't. I think, like so many people, I wish I had bought Amazon and held it or rebought
Hmm.
it when it was down there around 2002. But again, I think it's a lesson for a lot of AI investors today. Just because
Right.
those stocks do crash out in a year or so when the bubble bursts, doesn't mean
Hmm.
they're not going to go on to be the next Amazon and that next, 5,000% return.
Yeah, but it's always easier to say that once like it's
Sure.
done like 10 years after, right?
Sure.
So I mean, we don't know that. We can't predict the future. So I
Mhm.
mean, and what does your asset allocation look like today?
Well, I've always been very much in the camp that you do need a diversification in your assets, really. So it's about 2/3 equity, so about 65% stocks. I'd say probably 15% bonds and cash, so bonds and money market accounts. That's a little bit higher than I usually keep, but just the fact that we are so overpriced in stocks right now, I think I have a little bit more bond and cash portfolio. About 10% still in real estate through REITs as well as direct real estate holdings, and then still about 10% in venture capital companies, so startup companies.
All right. So since you invest in ETFs and also in individual stocks, how would you describe the role of each in your portfolio? Because we have a lot of listeners who do both as well. So what do you think ETF brings that individual stocks don't and vice versa?
Well, I try to keep to the kind of core satellite strategy, right? Where you have maybe 50 to 60% of your, and this is probably your entire portfolio, or you, just your equity part of your portfolio, 50, 65% of your portfolio in ETFs, right? These are diversified. These are your sleep at night investments. They're going to give you that market return no matter what, right? And a lot of times you don't even think about them. They don't bounce up and they don't bounce down on any given day. So you just kind of have them in your portfolio. You know you're always going to get a good return off of those, and you don't worry about them. But also, ETFs also give you exposure to themes and industries where you don't have maybe a lot of experience. A lot of
Right.
people don't understand that equity analysts generally only cover maybe a few industries or even one sector, right? That you have very few analysts that just talk about all stocks in general, right? And
Hmm.
it's because you really do need that experience in the industry or in the sector to really be able to
Right.
analyze those stocks. One very good example is biotech stocks, right? Those drug
Hmm.
makers within healthcare. Unless you've got pharmacy background, drug research, medical research, some kind of very intense experience in that industry, it is very hard to tell what biotech stock is going to do well. I like the industry. I think the growth there is excellent, but unless you have that experience, it's basically just a coin flip whether one biotech is going to do well or another is going to fail. So that's
Right.
one that I would use an ETF for, to get exposure to that industry and to that growth is like a biotech ETF.
So doing it that way, you kind of avoid having duplicates also, right?
There is some duplicate. Obviously, if you've got a larger, broader market ETF, the VOO, the SPYs, the S&P 500, and
Hmm.
then investing as well in tech stocks, then you're going to have a lot of overlap there. But generally, most ETFs are so spread out across stocks that maybe if you're buying Apple individually and you've got maybe 5% of your ETF in Apple, it's not going to be really a problem because
Hmm.
the
Hmm.
exposure to Apple in that ETF is so small that it really doesn't add much, as far as duplication.
Right. And do any of your stocks pay dividends? Is there like any place left for dividend stocks in your portfolio?
Sure, sure. There's still a dividend investor in there. I try to keep my dividend stocks and any kind of income generating stocks in a retirement account so that I don't have to pay those taxes every year, because those taxes can be a huge drag on dividend paying stocks. But I hold the J.P. Morgan, the equity, the Nasdaq Equity Income ETF. I think that's the GQ. The SVOL, the Simplified Volatility ETF, is a great fund. I think for really a different asset class because they're investing in those futures, those shorting those volatility futures, which is going to be a different asset from regular equity. So I think it has a very nice smoothing effect on your equity portfolio, as well as just Main Street Capital, which is a very well managed business development corporation.
And because you're American, I'm tempted to ask a question. Here in Canada, we have registered and non-registered accounts, and sometimes like you would prefer to invest in one of or the other depending on the type of stocks you own. So what would it be for Americans? Like would you invest high yielding stocks in registered accounts and growth stocks in non-registered or
Sure.
vice versa?
So is the difference the taxation
Yes,
of them? Okay. So I guess the registered ones are not taxed. They're your retirement accounts. You have to hold them a
exactly.
certain time. Yeah, it's like our retirement accounts, our 401ks, our IRAs, things like that. So yeah, that's where you would want to put your income stocks, your dividend paying stocks, and then your growth stocks in the non-registered ones, right? Because the growth stocks, you don't pay any taxes on them until you sell them. Right. So if you're
Hmm.
holding them for, 5, 10 years or what have you, then you're not paying taxes anyway. Whereas the dividend stocks here in the US anyway, you pay a tax on those dividends you collect, whether you
Yeah.
reinvest them, whether you let them stay in the account, whatever. You don't even have to withdraw them. You still have to pay taxes on that you made each year, unless they're in a retirement account or a registered account. Then you don't
Hmm.
have to pay taxes on those.
Okay, so it's very similar to Canada. So you said you're also interested in REITs. What type of real estate do you aim for?
I do invest more in diversified REITs anymore just because I don't have time to research the properties and the property types as much as I used to. I'm not quite as
Hmm.
active in the real estate market as I used to be. So I tend to go for those diversified REITs, the ones that hold different properties across the entire country. But I also like data center. Obviously, we're seeing a huge data center boom with the advent of AI, the communication. So the cell tower REITs
Hmm.
also fold into that, as well as industrial REITs, right? As we go more online, more into e-commerce, then really those industrial REITs, those warehouses that are storing the product and receiving the product and shipping the product, those are the ones that are really replacing retail real estate
Right.
as the big property type.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you, so please spread the love. Thank you. So, before we recorded this episode, you told me you invest for retirement, but with a 3 to 5 years holding period. As I plan to hold my stocks for at least 10 years, I'm curious about your strategy. Why did you choose that?
Well, I like business cycle and macro, the big picture investing, right? And I think it's obviously you never know where the stock market is going to go from month to month and even year to year. So it doesn't make much sense to try to time the market in that respect. But I think you can time those cycles, right? The bigger picture cycles, the economic cycle, the business cycle, those big picture macro level ideas, right? And that tends
Mm-hmm.
to match up fairly well with 3 to 5 year holding periods, right?
Okay.
The stock market tends to run in 3 to 5 year bull and bear
Right.
market cycles, things like that. So, and that doesn't necessarily mean I'm only holding a stock for 3 to 5 years and then I move on. Basically, I'm investing, maybe bull investing. So I'm long most equity positions for 3, 4, 5 years. And then maybe I'll have a year of where it's a little bit more cash holding, that kind of thing when stocks get more expensive. But that 3 to 5 year holding period just means, at the end of that holding period, then I'm reevaluating a lot of these stocks and the market in general. Right. So if I think, the bull market's going to keep on going, then I'll hold on to those stocks for a little bit longer. If I think things are getting a little bit more expensive, I might sell some covered call options against them to lower my risk a little bit. I might sell out of some of those positions, take some profits, or I might even go into, maybe a little bit more value stocks, dividend stocks, to be able to
Mm-hmm.
withstand that bear market a little bit better.
So you're not necessarily evaluating according to the business itself, but according to the cycle that we're at.
Yes.
Okay.
Yes. I mean, because generally you go back and you look at the companies, generally those competitive advantages they have are pretty durable and they're going to be longer lasting. So if you find that they still have that competitive advantage over their peers, they're still posting stronger than industry revenue growth, operating margins, things like that, then
Yeah.
you can pretty well say that that company is still going to be a good investment within that industry. Now, whether the entire market or the entire economy really lifts that industry up or holds it down, That's really the big picture. And I think probably the easier picture to get right for investors, they say the rising tide lifts all boats, and the rising economy is going to lift, all industries and especially certain industries. So I think it's much easier to see that where, the economy or the entire market is maybe a little bit overextended and ready for a pullback than it is to say one particular stock is ready for a pullback or something like that.
All right. And how would you describe your buying and selling process?
Usually in something kind of like tranches, right? I never just buy an entire stock position or sell it. Usually I will, if I own a stock and it's going up and it meets kind of where I think is a fair value or beyond my target price there, then maybe at first I'll just sell some covered calls against it, right? So I still have a little bit of upside in that. I still own the stock, but then I've lowered my risk because I've sold another investor the right to buy that from me for a certain price, right? So I've collected some cash on it, I've lowered my risk on it, but I still have a marginal amount of upside left. If it keeps on going, then yeah, maybe I'll reevaluate it and say, okay, you know what, I'm going to outright sell some of that position, and then do that in increments so that I'm not really missing out on the real big runaway stocks if they do keep on running, but then I am, starting to scale back my risk on those. And I would probably do that, buying a stock as well. If I think a stock is a good investment, then I might put maybe 50% or half of the money that I would have invested in it, but 50% now, wait another month or two, kind of see where it's gone, what it's doing, and start buying in with the other half.
Okay, so I can see that you're a very experienced investor and also you know what you're doing. Like you really are a professional and I appreciate that. But I'm used to like the philosophy of keeping things simple and follow like a strategy for a long period of time. So since you touched to all of those different type of investment, how would you describe your strategy? Like what's your main plan? Like if you could summarize it, but
Okay.
how would you describe it?
I'd say I'm a growth investing, probably active management growth investing, right?
Mhm.
So this is for someone with more than 10 years left to retirement, or really doesn't plan on retiring, something like that, where they want to see their portfolio grow, right? They're not necessarily needing that income. They're not necessarily living off their dividends or really have that in the near future. So it's a little bit riskier. Yeah, obviously you have that active management component, so it's got to be someone that
Mhm.
enjoys following stocks, analyzing stocks, and doing that kind of thing. If you don't enjoy, get some kind of intrinsic value out of following stocks, doing that analysis and doing that work, then you just index invest, right? You just
Mhm.
buy those ETFs, get the guaranteed market return. Basically, you've got your dividend stocks that Pepsi is never going to go away. It's always going to do what, or it's going to outlive us anyway. So you can invest in those very long-term stable companies like that. So I would say definitely this type of active management growth investing is something where you have to enjoy doing it to make it
Mhm.
worth it.
Sure. And what do you enjoy about it the most?
Really, just digging into a company's financials, seeing, maybe trying to see what the market doesn't see, trying to see where the market is, mispricing an individual stock, as well as just following those big picture ideas, right? Like I said, I really like to follow the macroeconomic cycle, the broader trends in the market,
Mhm.
like AI, things like that, and see, investing in those on the way up, but then saying, okay, maybe it's a little bit overextended now, maybe pull back a little bit. I don't know. I like not losing money much better than I like making money sometimes. So it's very nice to be able
I
to
get the difference,
follow,
yes.
yeah, follow a trend up, make money off of that AI trend. But then maybe if I'm out or if I've covered a lot of my stocks, before the market, peaks, that's fine. I can deal with not making all the money possible if I
Mhm.
protect myself from the downside as well, which I guess a lot of that is a function of when I started investing in 1999, that experience of just starting and then the bubble completely burst and pretty much wiped me out, like it has so many other investors in different bubbles across that. So
Mhm.
again, yeah, I can live with not making all the money in the world as long as I don't lose it all and have to start back from zero as well.
Okay, so let's use one of your holdings as an example. You wrote me that you were proud of SoFi Technologies, which you bought for around $5 and now has a stock price of around $14. However, I saw like I went and checked the graph because I was curious. This stock dropped like a rock between 2021 and 2023, which like raises many questions to me. What did you base your decision on to buy it?
Well, when it did drop, that was when a lot of the Fed rate cuts were just getting started. A lot of those new growth stocks were dropping like that. I actually started investing, I'd say right around 2022. So after those
Mhm.
big drops, I really got excited about a lot of the stocks that had dropped so much that, again, just like we saw in with the bubble burst in 2000, I think just like we'll see in a couple of years with some of these AI stocks, you see a lot of these stocks that had so much promise and so much investor enthusiasm drop. The investors just get scared out of them completely, but they are still good companies. And what I saw was a bank here, SoFi Technologies. It is an online bank, and how it's different, how it was different anyway. So some of the other
Mhm.
companies have gotten that. It acquired a traditional bank, right? So it had a banking charter. Now that is very important for banks and fintech companies because most fintech companies they don't have that banking charter, so they can't offer deposits, they can't offer a lot of the traditional services a bank has, and they can't collect deposits, right? For a bank, those deposits it collects, it holds for people are very low cost funding. Okay. Think of how much your bank pays you for the money you have in your account, almost next to nothing. So when a bank has a banking charter like that, it can collect those very low cost deposits, lend it out on loans and other services, it can have checking deposits, things like that. A lot of other fintech companies just didn't have that, right? You had other companies. Whereas, so SoFi had that, so not only did it have the cost advantages from being an online bank rather than having to manage all those branches like maybe a Bank of
Mhm.
America, not only did it have the cost advantages, but it had the revenue advantages as well for being able to collect the deposits and lend out. So a very strong growth as well. It's it was growing users, growing revenue right around 30-40% a year. So very strong revenue growth and user growth for a bank. It actually, through the banking crisis over the last couple of years, was one of the few banks to actually grow its members and deposit base rather than losing it, and at a great valuation. Right, when I first started buying SoFi, it was trading at right around a 0.8 times price to book value. Of course, that's the metric you want to use with banks because of how they put their loans and their or the assets and
Mhm.
liabilities on the balance sheet. It's very easy to get a sense of what their actual value is. So very good valuation, strong competitive advantage, as well as growth in the bank.
What would make you sell it?
Well, I did actually, cover a lot of my position with the $12 calls, strike calls. At that point, at $12 a share and above where it is now, it is just way more expensive than it should be. Right now, I think it's trading for right around 2.6 times price per share divided by book value. So 2.6 times its book value, which no bank is worth that much, no matter how fast it's growing. Again, I started buying at 0.8 times book value.
Mhm.
So I did start, covering some of that with $12 strikes. I collected some of that money from that other investor to buy those options and covered that position. So I did, sell in a sense, a form of selling in that I lowered my
Mhm.
risk in it. If it falls below $12 a share, then I'll keep those shares. If it stays above $12 a share, that investor is going to buy them for that price. If it did get down to, I'd say maybe about $10 or $11 per share, I'd say, I'd start reevaluating the price on that and maybe buy back in.
All right, so it goes back to your philosophy of not necessarily getting all the money, but not losing too much, right?
Exactly. Yep. So
So,
from $5 per share to, I mean, with the call options, I probably got up to like $13. So that's pretty good, as 160% return on those. I'm fine not getting it all the way up to $15 as long as, yeah, if it comes back down, then I don't get burned by that.
so would you say, I'm sure that some listeners are thinking about that right now. So would you say that you invest in trends?
I would say, and I guess there's a lot of different trends. You could say macroeconomic trends, economic cycle trends. You could say AI trends. I do try to see, what kind of trend is really kind of the big theme or thing in the markets. It's hard with some of the specific stock trends like AI. You had the Magnificent Seven a couple of years ago. With a lot
Right.
of those, as soon as you hear about them or when you hear about them in the market, they're basically on their last legs anyway, right? A lot of
It's
times,
already late.
right, when something is named, the Magnificent Seven, it's because, those stocks in that have done so well that it's gotten people's attention and they, felt they needed to put some kind of funny acronym to it. So the fact that they've already come up so much means, yeah, a lot of the easy money is already out there.
Mhm.
So
Mhm.
I think you can follow those trends. You can evaluate the individual stocks in them and see, which ones are the better investment. But a lot of times it's not necessarily a trap, but not something that's going to make you the easy money that it would have in the past.
So I'm going back to my first point, one of my first actually. Since you're a growth investor and you base some of your buy and sell decisions on valuation and price, does that mean you have to follow your stocks like daily?
Not daily. I'd say, you're probably reevaluating your individual stocks quarterly. Certainly, when those quarterly reports come out, those
Mm-hmm.
financial statements and things like that, you're looking for any big changes in really either the revenue growth or the revenue growth outlook or the profitability, so the operating margin. If there's big changes in there, then it might be some kind of a hint or a clue to a change in that competitive advantage, right? Because that's really what you're investing for in a company, is a competitive advantage over its peers. Okay, so you can use the little bit bigger picture, higher level analysis to find, okay, which industries are doing really well. Is it AI? The industries within AI, maybe the server construction, the hardware, the software, and use cases, things like that. So you find your industries with a good growth perspective, and then you find the companies that are doing best in those. Okay, and then yeah, you do need to reevaluate, I'd say, on a quarterly basis, maybe
Mm-hmm.
even 6 months, to make sure that that company that you're in is still, one of the best in the industry.
And I'm glad that you mentioned that because we have seen at Dividend Stocks Rock, the website that I work with Mike, we have seen investors opening their brokerage account daily and following the news and writing to us like, why is stock XYZ down 5% today? And we keep on saying to them, well, it doesn't necessarily matter. Like, even though there is a news today, you have to check on that like at the end of the quarter, right? So I'm very glad that you mentioned that because you have a growth perspective, a growth strategy. And even you who invest for a shorter period of time, you don't follow your stocks daily. So I think it's a very good point. Okay, so basically I want to make this as straight as possible for listeners and people who might not be familiar with your strategy. You have like a stable and reliable base with ETFs, REITs, bonds in your portfolio. And then you add like some spices and things that you are interested in with your individual holdings, right?
Yes. Yep. I try stick with that core, think about that core satellite strategy first, right? So you have, 50, 60, 70% of your portfolio in just ETFs, right? Whether that's, stock ETFs, bond ETFs, REITs, you've got all your asset classes in there. You're going to make the market return on those easily. Don't even have to think about it. Sleep at night portfolio. Then you have that 30% or more that is basically your individual stocks, right? Where you can invest in maybe even 5, 10, maybe as many as 15. I wouldn't recommend more than maybe even 15 individual stocks because you do need to every 3 months or so, or every 6 months, reevaluate those stocks and try to find the best in within a specific industry. So just a very small handful of stocks that you really like and you really think can do well.
Listeners, let's empower you in the investment world with our free Dividend Rockstar list, which includes stock ideas with positive dividend triangles. How does the list help investors, Mike?
Vero, we survey regularly our members and our readers, and we ask them what are their biggest struggle. And one that keeps coming back is really the buy struggle. Most investors don't know what to buy, they don't know when to buy it, and the Rockstar list will help them grow a little bit more their conviction, because that list of stock will just include companies that show great financial metrics. Of course, you cannot start by picking them blindly, but it's a pretty good start to make sure that the company that you're about to read and know their business model is actually a business showing revenue growth, earnings growth, and dividend growth. The way I use it usually is I will filter it by sector to identify a sector that I want to have more exposure to, and then I just look for companies that have the strongest dividend growth model.
To download the list, enter your name and email at thedividendguyblog.com/rockstar. Again, hit pause now and go to thedividendguyblog.com/rockstar. And what was your biggest mistake as an investor, and how do you ensure that you avoid repeating it?
Oh, well, I think kind of twofold on that. I had started investing in Peabody Energy, a company called Peabody Energy. It's a coal producer here in the United States. Right around probably 2010, I'd say 2012. It's been a while. But, one, Okay, so at the time, then the government was coming down against coal producers, trying to shift people to natural gas and cleaner renewable energies. So coal was obviously falling, coal prices were falling, and the companies weren't doing very well. So the stock started coming down. I started buying, thinking that okay, even though the environment and the economic environment and regulatory environment is against coal, it was still something like 40% of electricity generation, right? So you still got that very much demand use case for coal.
Mhm.
Peabody was the largest company then, and had that financial flexibility to survive if things got worse even then. So I started buying on the way down. So one mistake was I just kept on buying on the way down, right? And got away from that, that limitation that is the core satellite strategy where, if you've got 70% of your money in ETFs and only 30% in stocks, and even that spread across, 10 plus stocks, then you're not going to have, very much in one stock. So you can't lose very much in one stock, right?
Mhm.
Well, I kept on chasing those shares down and investing more and more. And eventually it got to be, a much larger part of my portfolio, 15, 20% in just this one stock. So that was mistake number one. Mistake number two was really not trying to see the bear case of it. I think we can get emotional. We can get invested
Right.
in our stocks. Think, okay, this company that I've invested so much money in, it's got to come back. The bears don't know what they're talking about. It's going to come back up. You don't give that analysis it's due, right? So I didn't look at the bear analysis. I didn't look at the debt, which is very important. Any stock that is coming down quite a bit and really seeing trouble, you really have to go in there and look at their debt on their balance sheet when their debt maturities come due, and to make sure that they can pay off that debt. That's generally the case when, well, obviously, when a company eventually bankrupts, like Peabody did in, I want to say 2014, then it's because of that debt, right? It's because
Right.
that debt kept on building up. They couldn't pay it off. So if you are going to be following a stock down, investing in those deep value cases, because they always look very much like a value stock, then you really
Mhm.
have to pay attention to that debt and where it's going. If the company does have that cash survivability.
Right. So, just for the fun of it, name one or two stocks on your buy list and the reasons to buy them.
Okay. Well, I have shifted into Ally Financial, right, from SoFi, which is too expensive for my taste now,
Mhm.
into another fintech, another online bank called Ally Financial. It's ticker ALLY. It has many of the same advantages that SoFi does. Not quite the growth of SoFi Technologies, but it is a very well run bank. It has respectable growth in sales revenue and so forth, and good operating profits as well. And it's only trading for like 0.85, maybe zero point 0.9 times price to book value, right? So it's trading
Okay.
for good valuation under book value. I mean, Warren Buffett owns like 15% of the bank, right? 15% of the shares outstanding. So there's some confirmation there in his credibility as well, I guess. Beyond that, I think AMD, so Advanced Micro Devices, is a very good stock right now. Obviously, it doesn't have that AI market share that NVIDIA has. It's kind of
Mm.
overshadowed by NVIDIA, but within the chip making stocks, which semiconductor stocks, chip makers have a very strong momentum and strong trend. That bigger picture overall trend, very strong growth in those. And I'd say AMD is probably the second best chip maker, right? And is trading at a very much more attractive valuation compared to NVIDIA. I think NVIDIA
Mhm.
right now is trading for a price per share divided by its revenue, price to sales of about 30 times, right? So for every you're paying $30 for shares of Nvidia for every dollar in revenue they actually generate, right? For
Mhm.
AMD, it's closer to about 6 or 8, right? 8 times.
Okay. Yeah,
So you're
big
paying
difference.
$8 for every dollar in revenue generated, and it's still growing by about 20% a year on that revenue growth. So very strong revenue growth. I think AMD is benefiting most from really the fallout of Intel. Right, Intel released a gaming chip a
Mm.
few months ago called Arrow Lake that was a complete failure, had a lot of bugs in it. Even their fix to those bugs really didn't help the chip. So AMD is actually seeing shortages of its own chip that replaces that is a good replacement for that Arrow Lake chip. So I think AMD is doing very well. Not necessarily taking a lot of market share from Nvidia, but taking a lot of market share from Intel. And I think AMD is going to be able to take, because with Nvidia and their Blackwell chips, Blackwell is taking longer to develop. There's some rumors that they're overheating. So I think AMD is going to have an opportunity to take some of that AI market share as well.
Very interesting. And AMD is not paying a dividend yet, right?
No,
At least not yet, like I
no.
said. Okay, so one last question before I let you go, Joseph. Since you have such an interesting and diverse background. How do you envision your retirement years?
Actually, I don't know that I would retire. I mean, what retirement, right?
I
When
love
you
it.
when you enjoy doing something so much, then I can't see myself stopping. I don't have a lot of hobbies, so you can only play pool maybe 1 or 2 nights a week. Of course, I spend time with my kids and that. But no, I might pull back a little bit and do more of one and less of the other. But I enjoy following stocks. I enjoy analyzing stocks, and I enjoy sharing that with a community on YouTube.
So, if you want to learn more about Joseph, you can find him on YouTube at Joseph Hogue. Of course, I will put the link in the show notes, thedividendguyblog.com/221. Thank you so much for accepting the invite, Joseph. It was a pleasure to discover your strategy.
Thank you.
Listeners, if you enjoyed this episode, hit the subscribe button underneath our podcast logo and help us grow by sharing it. For the show notes and related content, visit thedividendguyblog.com/221. If you'd like to appear on the show, message me on the Dividend Guy blog Facebook page or at the Dividend Guy on X. Until next week, stay invested.
Hey fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.